Okay, so here we are. We're at the Francis Financial third quarter 2013 review, and we're very excited today to be talking to you a little bit about what we're expecting with the markets over the next several months and actually several years, and also having a review of what's happened this last quarter. I think we all can agree that this last quarter has been quite volatile and a lot going on. So with that, I'd like to get started. Again, my name is Stacy Francis, and my company, Francis Financial, we are independent, fee-only wealth management firm. And with that, we work with individuals, helping them with comprehensive financial planning, as well as ongoing wealth management. And with that, we work with about 100 clients. We manage about 120 million, and we meet with them as often as every 6 weeks to make sure that they're on track to reach their financial goals. And that's what we're going to be talking about today. How can you make sure that you are on track to reach your financial goals, in particular with your bond portfolio and in your stock portfolio, in a time where we're seeing a lot of volatility in the markets, and most likely you have a lot of concerns too. So let's go ahead and get started. This is our agenda today. We're going to talk about a summary of what's happening currently in the past in the market. We're going to talk about the looking forward market and economic review. We're going to look at our portfolio positioning and what we need to be thinking about over the next couple months, as well as even the next couple of years. So go ahead and take a look at this wonderful chart we have on the right, and you will see that this portfolio here is the asset classes. And just go ahead and take a look at the third quarter and the year to date, and you'll see some really interesting numbers there. And again, make a note of the ones that you are most interested in. So as you can see, U.S. Treasuries even had a loss year to date. We also have our U.S. investment grade bonds had a little bit of a loss. We had a little bit of a loss in emerging market stocks. However, those trends were greatly reversed during the third quarter. And the third quarter, you'll see that emerging markets did wonderfully, 4.3%. We saw investment grade bonds just barely be positive, and then U.S. Treasuries, again, just barely positive. Where are we seeing the most growth in our portfolios? We're actually seeing them in U.S. stocks. Year to date, we are up 19% for U.S. stocks. Small cap stocks have done phenomenally well, almost 28% return. Also, developed international stocks, that's Germany, France, UK, you're looking at 15.1% return. So, overall, I mean, you can see we've had a phenomenal year. Our biggest concerns about what is going to be happening going forward with the market. So let's go ahead and take a look at that next. Essentially, what's happened is that our portfolios benefited from a lot of active manager outperformance across most of our bond portfolios. Also in our international stock funds. It actually helped us offset our underweighting in stocks. We have been underweighted in stocks over the last, essentially the last year and a bit, and that is because of our ongoing concern about U.S. stocks being overvalued. I think we can all agree that U.S. stocks now are at somewhat of nosebleed levels. And going forward, we expect that there's going to be insufficient returns to really compensate us for the risk that we are holding with our U.S. equities. So because of that, we're underweighted. We'll talk a little bit more about that more in the presentation. For emerging market stocks, they actually continue to look attractive across our next couple years, as well as 5-year scenario. The biggest concerns we have are actually, interestingly enough, near term, and that is from China's credit and infrastructure bubble. Essentially, what China has been doing to help inflate their GDP and keep the growth figures being very positive for them is that when GDP seems to be slipping, they invest in infrastructure. And as we know, you can only have so much infrastructure building before you can actually end up with a bubble. So that's something that we're continuing to watch. However, we did see a lot of our concerns somewhat allayed over the last quarter. China's fundamentals are starting to look a little bit longer, little bit stronger. We do remain tactically underweighted also to core bonds. Core bonds are more interest rate sensitive than many of the bonds that we've chosen to invest in. We've invested in floating rate bonds, emerging market local bonds, some high yield bonds as well. And these are a little bit more active strategies. And because of that, we've actually been able to generate some higher returns. And this has helped us significantly in navigating the interest rate environment that we're seeing right now with interest rates rising. So this is another wonderful chart. I know that all of us like to see numbers in different ways. This is that beautiful chart of showing you each of the different asset classes and how they have performed both on a year-to-date as well as a third quarter basis. And essentially what I want to show you again and bring your attention to is the bond area. So floating rate bonds, the third quarter did well. You can see that they've done phenomenally well, almost a 4% return year to date. That's phenomenal from a bond and as far as a return. High yield bonds have had a nice return as well this last third quarter, and year to date they're up around 4% as well. That has dramatically helped our bond position over the last 9 months or so. Instead, you'll see investment grade bonds have actually been performed poorly. As we mentioned before, we're somewhat light in investment grade bonds. So why is the S&P 500 now at nosebleed levels above 1700? Why are we seeing this when the economic fundamentals underlying it just don't necessarily make sense? And you'll see here, starting in 2008, that in the big drop that we all very much know and remember, and many of us very painfully remember. And you'll see that the market, had recovered well through 2009, 2010. We gave back some returns, and that was Bernanke setting the stage for QE2, which helped spur another wonderful set of expansion. Here we had Operation Twist, and again another set of expansion. As far as the more recent that we're seeing here is that we're seeing the Fed starting to talk a little bit about pulling back and essentially talks about tapering their bond buying purchasing program. Essentially, over time, talking about how they're going to have less of an accommodative policy, more of a restrictive policy that could impact the market, could impact the economy, and more importantly, affect the growth rate of the United States. When we see GDP reducing for the United States, often you'll see in turn profitability in the corporate sector will be hurt, and that definitely translates into more pressure on the stock market, and often you'll see quite a few losses in the stock market. That's a concern, and just even the talking about that possibly being considered as a policy going forward, you can see is quite a major dip. One of the biggest questions that we have going forward is that the quantitative easing or the accommodative monetary policy that the government has right now, eventually there has to be an end. There's only so much money that can be flooded into the market. In particular, we all know and have lived through the concerns and the political debates and unfortunately political arguments about the debt ceiling and how we're going to actually pay off this very massive deficit. And so with that, we're going to see that eventually down the line, the Fed is going to have a more restrictive policy. And that is a concern. Again, a concern of ours about how the stock market is going to respond to that. Here, as you can see, just talk about possibly considering a tapering of the bond buying has a pretty massive effect. So that's one of our big concerns. I'll be honest, making sure that the stock market doesn't react too emotionally to that and overreacts, sending it into a spiraling downward turn. So this is the other piece we're concerned about. When we look at the overall health of the stock market and we look at the overall health of corporations, corporations have done well. We've seen some really good profitability numbers, and even some have come out lately going in that right direction. But this is the biggest concern. You can see that typically, historically, going back to 2009, 2010, and 11, that the S&P 500 performance, which is this gray chart, this gray line right here, has not exactly mirrored, but been somewhat close to the gap trailing 12-month earnings per share of the market. And as you look at this, you can see that we're in a unique area where the two have really diverged from one another. That's one of the areas that we're concerned about. We're not sure that we're actually trading in what we call fair value range. This is closer to what we call fair value range for the S&P 500. That would be anywhere from 1,400 to 1,000. I went through and we made this chart for you as of today, trying to be as timely as we possibly could for our call today. You can see that we're above 1,700. And what that means, if we expect with a subpar recovery, which we believe is the most likely type of recovery going forward and what we're experiencing now, unfortunately, we're expecting something closer to a 2.3% return each year over the next 5 years for the S&P 500. Now, we could be wrong. No one has a crystal ball. It could be such that we have more of an average recovery. And you can see there are a much, much bigger dispersion of returns in these two different scenarios. In an average recovery, where we are now, we could be looking at another 11.6% return each year over the next 5 years. So there definitely is some upside. However, what all of the modeling and the economic research that we have in front of us, and again, we don't have a crystal ball with all the answers, but what's looking most likely is unfortunately more of a subpar recovery. So let's take a look and see what emerging market stocks, how they're performing versus developed international to the US market. Here you'll see in blue from just this year, this is just focusing on year to date, starting out in the beginning of January and going all the way through till essentially about 2 weeks ago when we created this chart for you. The U.S. stock market has performed very, very well. It's interesting to also see our developed international market here has mirrored that market somewhat and not performed quite as well. How have emerging markets done? You'll see that the emerging markets have a very, very similar path, but has been much more exaggerated. You see a lot of growth here during the month of August. Emerging markets greatly rebounded, 100%, somewhat because of improving economic news in China. Actually, because where emerging markets are trading right now, they are extremely attractive to us over the long run. In fact, we find emerging markets and the value proposition of investing in this area to be much more attractive than US stocks, and actually even more attractive than developed international. As far as when we're looking at developed international versus US stock, you will see that over the next couple of years, developed international will most likely outperform the US stock market. There are many reasons for that, but part of the reason is because those stocks in developed markets they're just not trading at high of nosebleed levels that we're seeing for the US stock market. So what's happened to bonds? I know we've talked a lot about the equity market here, what's happening to the bond market? Essentially, we've seen one of the biggest sell-offs in core bonds that we've seen in 30 years. And essentially, what you can see is very clearly the Treasury rate here in the gray, and then you can also see on an annual basis what the return has been for the Barclays U.S. Aggregate Bond Index. Going back, we actually went back to this chart all the way back to 1976, and you would have been very happy with your aggregate bond index with more than a 15% return. Treasuries were at almost 18%, so pretty phenomenal. However, what has happened? You've seen an ongoing trend over the last 3-4 decades where we are looking at actually all-time low returns for bonds, particularly core bonds. That is concerning. That's concerning because if you're looking at the U.S. stock market and expecting over the next couple of years that you're not going to be seeing much as far as compensation from investing in that, not expecting very high returns from that, you would think well, let's invest in core bonds. And these types of returns, and actually core bonds have actually been negative this year. We expect that to be similar over the next couple years. That's not really then the answer either. So where should you invest your money? That's the big question. I have the answer for you, but you're going to have to hang on just a few more slides and I'll tell you what that looks like. So on the bond side, how can you continue to have that conservative part of your portfolio, the part that we all need for income producing? Essentially, I call this part the airbag of your portfolio. How can you continue to have that wonderful conservative portion of your portfolio invested in bonds and not see losses? Well, this is something that we've thought about and spent a lot of time finding a good solution. And we have one. The Barclays Aggregate Bond, you'll see, is actually negative year to date. Here you'll see some of the wonderful bond funds that we're using, and none of them have underperformed that bond aggregate index. In fact, a few of them, the Loomis Sales Bond is up 3.35%. Phenomenal, essentially 5% higher, more than 5% higher than the aggregate bond index. You'll see the Osterweiss Strategic Income, that is up 6.5% higher this year, which is wonderful. You'll see the floating rate also and the institutional floating rate both doing very, very, very good. Essentially, what we've been doing is underweighting core bonds, and we've been working a little harder to find other options, other types of bonds that are not as sensitive to interest rates. The losses that you're seeing in the Barclays Aggregate Bond, that's negative 2%, it's because interest rates are rising. As interest rates rise, bond prices fall, and that's where you see losses. We know that that is going to be part of the thread and the fabric of the market over the next couple years. Interest rates are at historic lows and continue to be, and we've seen some increasing of them, but we expect there's a lot more to come over the next couple years. So in preparation, around a year ago, we started to construct the portfolios in a different way, and that is to make sure that we had different types of investments that were less interest rate sensitive. And I want to just show you this chart because this is, I think, a wonderful chart that shows you the yield of each of, the aggregate yield of each of these investments. And then down here, it shows you the interest rate sensitivity. Now, just to try and give you a little bit more information, we also added the Vanguard Bond Market Index. We actually right now are not invested in that, but I think it's wonderful because this is essentially a benchmark that you can use compared to the different investments that we're looking at and have in our portfolios. So you can see that the most attractive is the DWS floating rate bonds. Look, we have beautiful yields, and the interest rate sensitivity is extremely low. What's wonderful about these funds, in just a very simplistic way, is that with the name, as the name explains to you, as rates rise, these funds, the rates on them also rise. So that's a simplistic way of again showing you how they actually respond while interest rates are rising. So that is one way that you can kind of hedge your risks against interest rate rises. You'll see that over here, our most interest rate sensitive is the PIMCO total return. We do continue to hold this. This is a great investment. Bill Gross, we all know Bill Gross has been there for decades and decades, and really one of the thought leaders in the area of fixed income. We still are holding a small portion of this, but not as much as we had, let's say, a couple years ago. And so this is essentially why we have seen in all of our portfolios that we have continued to perform relatively well, as you saw before, relative to the bond market. And essentially, with this overweight to what we call absolute return oriented funds, floating rate funds, and emerging market local bond funds, that is why we're seeing, again, positive returns in an environment when our benchmarks are negative going forward. So what type of recovery are we going to have? There are many different types of recoveries. Right now, we expect more so of a subpar recovery. That's what we've seen today. It's what we expect going forward. We made this chart to give you an idea, to show you the vast dispersion of different types of returns based on our four types of scenarios. The one that we're going to focus on today is the subpar recovery, but I'm also going to dip into the average recovery, because I think that that's very important to just show you that if again our markets do better, our economy strengthens, that GDP is not impacted as we expect it to be by paying off of the deficit, what things might look like. So we have U.S. equities, our return, again, this is over the next 5 years, 2.5% each year over the next 5 years for subpar, 11.9% for average. As far as Europe, developed international, 6.9%, really nice. If it's an average recovery, we're looking at 16%. Emerging markets, I know you've heard us talk a lot about emerging markets and the potential opportunity there. This is why. Even in our subpar recovery, we're expecting 12.6% returns each year over the next 5 years. If we have an average recovery, you're going to see that will jump to 20%. Investment grade bonds, no great story here in either of the scenarios. High yield bonds, not a bad story, but not anything to get too excited about. Floating rate loans, that's where we're going to see in our floating rate bonds. These are what we're going to be expecting a lot of our return from, particularly in the fixed income area. And then emerging market local currency bonds. So these are bonds as well, but they are actually emerging market bonds, and we're expecting mid to high single digit returns, which is wonderful. Those are essentially equity type returns from fixed income. And then we have our arbitrage strategies. These are arbitrage strategies that are considered to be market neutral, and we don't expect that we don't see that there is a very big correlation between arbitrage and what the market does. That's a fancy way of saying that if the S&P 500 goes up, goes up 3% in one day, our arbitrage strategies, we may see some uptick in them, but that is, it's typically not tied directly to what the S&P 500 is doing. That's important. We do want as much diversification as we possibly can have, because if you have a 3% increase in the market, most of us are happy to have the rest of the portfolio go up by 3% too. However, if you have a 3% loss in the market, we're never very happy about seeing the entire portfolio, all the other pieces, all the other asset class going down by 3%. That's not ideal, and that's why we want diversification. Certain asset classes we want to be increasing in value, and clients may not agree with me, but I want to make sure that other asset classes maybe are not doing as well. That's part of diversification, and it's part of protecting our portfolios. Essentially, putting on those ear defenders when you go to a concert, protecting that portfolio from the ups and downs of the market. we just, we don't expect a 2008 to happen in the near future. We just want to be prepared that if something were to happen, that we don't lose the entire portfolio. We really want to protect that portfolio and have an airbag below it. And our arbitrage funds and actually our fixed income, that is the role that it helps us play. Let's move forward. I want to talk a little bit about unemployment. There's been a lot of talk about unemployment. You can see we put this chart all the way back to 1948 to show you the unemployment rate axis here in gray, and then also the labor participation rate. What's interesting of where we find ourselves today, we're finding ourselves in an environment where we're looking and seeing better unemployment numbers. And there's been a lot of excitement about that. I'll tell you, I'm just as pleased as anyone else. But unfortunately, it's not as clear-cut a picture as we might hope. Much of the decrease that we see here in unemployment can be also tied to a decrease here in the unemployment participation rate. Why is that happening? What is it? The participation rate is the number of people who are claiming and saying that they're actively looking for employment. And we've seen two trends of why people are essentially removing themselves from the labor force. The first is retirement. We are going through a historic time in the American history, and we're seeing the most number of people retiring each day than we've seen in many, many years. In fact, I think if we look at the numbers, maybe some of the largest numbers of retirement per day in any other time in history. What is that? That is the boomers that are now retiring. So you are seeing that, people leaving the workforce because they are retiring, and that's natural, that's healthy. Unfortunately, the second piece that we sometimes also are seeing are those individuals that are leaving the workforce because they no longer feel that there is opportunity for them. With that is our biggest concern, because they will be returning to the workforce, hopefully, going forward when the economic situation improves. So they will be coming back, and we might unfortunately see a gentle uptick to our unemployment rate when the situation improves and more people get out there and start looking for work based on the number of people who have actually called it quits and said that there's just not a job out there for me. So again, we're going in the right direction with unemployment, but I think it's really important for all of you to know that there's more to the story than just what you see on this on that chart. Another wonderful positive is that rising home prices. They've been very positive for both the economy as well as the stock market, but we question this rally's sustainability. We question it because it has been the beneficiary of the Fed's ultra loose monetary policy by essentially suppressing interest rates. We know that over the last 12 months, housing prices have very much helped by the last 9 to 12 months, by housing prices increasing. It has helped many homes stay out of foreclosure, allowed a lot of people to also refinance. Our concern is what happens when interest rates rise. Will the new house constructions and starts, will the frenzied pace of house purchases continue in the face of rising interest rates? When interest rates rise, mortgage interest rates also go up, making that $1 million home more expensive. That home may have started at you may have been able to buy that home paying 3.5% on a mortgage, and now you're looking at possibly 5% on that same mortgage. It's something to really think about, and that's one of the concerns that we have. Now, one of the things that we benefit from here in New York City is that right now we're in a situation where there's a lack of inventory. So we're seeing the propelling increase in housing prices magnified here in New York. That is something that we expect to continue, but again, we have concerns that once interest rates continue to rise, will that continue? Our answer is no, not at least at the pace that we're seeing that as far as the growth in housing rates. So let's talk a little bit about debt. Now, I think we should all pat ourselves on the back. What's happened with household debt as a percentage of GDP, you can see that it's gone down. Consumers, you and I, have done a lot of work to pay off those credit cards, to get out from underneath homes with mortgages that were higher than the value of the actual real estate. We've done a lot to pay off the student loans, to pay off the automobile loans, payday loans, and we've come a long way. However, unfortunately, the absolute level of debt within the economy has actually not declined in a material way, because essentially most of it, some of it, has merely shifted from our private sector, you and I, to the public sector. And ultimately, the debt has to be paid back. So this government debt that you saw over the last couple weeks, the essential haggling over, again, how are we going to create the funds to start to pay the deficit back? Where are the cuts coming from? Where is the income coming from? This is going to continue to be a talking point going forward. And we expect that this deleveraging process is going to continue to suppress government spending. And when you see lower government spending, it does impact economic growth and reduces economic growth. This is another thing that we're watching and kind of watching as this play out on the economy. Let's talk a little bit about emerging markets. I love this chart because we saw that where we were with regards to our debt situation, and you can see also what's going on in emerging markets. And we went back to 1995, 96, 97. Then we jumped to 2010, 11, and 12. And you'll see, interestingly enough, for the emerging markets, developed Asia, Latin America, the Caribbean, the Middle East, and Sub-Saharan Africa, all of these different market regions have actually improved their external debt situation. However, you'll see that we have a different story here in Central and Eastern Europe. And we didn't add the US to this because we just spoke about the US, but you would see a similar situation as the US. This goes back to something that is counterintuitive, but we're actually seeing emerging markets in these other areas in the world of actually having very, very healthy and robust economies. So what types of returns can we expect? This is another way of looking at US stocks versus European stocks. You'll see that we included a line to show you what our base case 5-year return estimate might be. And overall, it's very clear that the types of returns that we expect, they're mostly going to be from equities, and they are going to be from the European stocks as well as emerging market stocks. The one thing I do want to let you know is that the European stock returns that we're looking at here, this does not include Japan. We've modeled out Japan differently, and just to give you an idea, the return expectations for Japan are very similar to our returns for US stocks. Let's move forward. I want to talk to you a little bit about our portfolio positioning. This gives you an idea of where we are positioned currently versus where we would be in a more neutral market. So as we spoke about, traditional investment grade bonds, they're again very interest rate sensitive. We are actually under allocated in that area. Absolute return oriented bond funds, we are over allocated. Why? Because essentially they have flexible strategies that can perform well even with rising interest rates. Floating rate bonds And emerging market local currency bonds, also we are over allocated. For floating rate bonds, that protection comes from rising interest rates and allows us to have potential higher returns in our bond funds. For emerging market local currency, they have extremely attractive potential returns from emerging market countries, with also less risk than investing in emerging market stocks. Let's talk a little bit about equities, and we highlighted equities in blue to try and delineate and make these a little bit easier for you to read. Larger US cap stocks were underallocated. That is because equities appear overvalued, and we look at the potential returns as quite low relative to the risk that we see in holding them in our portfolio. So again, of course, we do have large cap US stocks in our portfolio, but we're underallocated versus where we would be in a more neutral market. Smaller cap stocks, it's a similar story to US stocks. There's more downside risk to US stocks, and they tend to perform even more poorly when there is negative economic conditions. We have foreign stocks. We are neutral, and emerging markets, we're neutral and over allocated. I say neutral and over allocated because for all of our clients, we customize their portfolios, but this area in particular, because it's emerging markets, we do really customize in this area. Some clients don't feel comfortable having a huge allocation to emerging markets. And we understand why. There are some risks there, but however, we believe they're moderately attractive relative to the US, particularly on a risk-adjusted basis. We believe that there's a good amount of diversification benefit that we get as well. And then alternative investments, we're over allocated. We talked about the fact that it's very attractive risk-adjusted returns, and it has low correlation to stocks and bonds. So essentially meaning that based on what the stock and bond market's doing, we would not expect there to be a move either way that would not be impacted greatly by either of those. This is to talk a little bit more about that emerging markets case of why our equity position favors emerging markets. We see a compelling case for tapping the opportunities, and let me tell you why. Emerging markets make up 50% of the world's gross domestic product. So essentially, they are producing essentially half of the gross domestic product along the world. However, the market cap, or the number of actual companies located within the emerging market sector, is only 11.3%. That shows a lot of positives. And the fundamentals are really improving, and we expect that over time that this 11% that shows the gross domestic, the 11% of the market cap here, we expect that to increase as more companies move to emerging market countries. What's fueling this consumption? What's fueling this growth? Essentially having half of the growth of the entire world focused specifically happening in emerging markets. A couple things. Number one, the demographics really do favor emerging markets. They have a very young population, and they are also gaining a lot of knowledge from the developed world. I think we all know many people who have been able to come and go to Cambridge, Harvard, and many other wonderful college institutions for knowledge, and then gone back to their home country to be very successful and lead very, very productive lives. So there's a lot of knowledge transfer, again, from the developed world into emerging markets now. We're also seeing higher productivity per capita income, and we're seeing higher gross domestic product growth over the long term. Emerging market, we expect that the gap between, as I mentioned, their share of the market and ours to really narrow. We really want the clients to benefit from this opportunity, and essentially the downturn that we saw in emerging markets early this year, we really look at it only as a blip on what we expect to be as a long-term upward path. So our key takeaways. We continue to view the investment climate as highly uncertain. with a lot of risk and unfortunately short-term volatility. That is unfortunately the new norm. As we talked about, US stocks, we are not expecting them to generate high returns and that are going to really compensate us for the risk of overweighting, of having too much US stock equity. So because of that, we're somewhat underweight versus what we'd really like to have in our portfolio. We also have low returns expected from US investment grade bonds. And so because of that, we've really looked at other asset classes. And part of that is looking outside the United States and some other alternative classes, including using flexible and absolute return oriented fixed income, emerging market stocks, emerging market bonds, and also some of the alternative strategies that we spoke to you about. So with that, I just want to say thank you again for your time. Please let us know if you have any questions. Our website is francisfinancial.com. I know we went through a lot of material today, but we sit down with our customers, with our clients, and really talk through their portfolio. These are wonderful, general, broad brushstrokes of what we're doing with each portfolio, but understand each portfolio is customized. Every client is different. Every client has a different investment DNA. And working with a small firm, we have the time and we can work with you and give you the attention you need to make sure that your portfolio is 100% reflective of your risk tolerance, is going to make sure also that you get to your goals in a way that you feel comfortable. We talked a lot about there being volatility in the market. There's a lot you can do to protect your portfolio against that. If you're not a roller coaster enthusiast, I have to say that making sure that your portfolio is invested properly, having an essential airbag to catch it and help boost it up during bad times, and making sure that there's enough growth to make sure that it increases in those good times is really important. So let us know if we can help you. We're always here. So www.francisfinancial.com. You can also reach out to me, Stacy Francis, President of Francis Financial. I'm at 212-374-9008, and you can always email me, stacy@francisfinancial.com. I want to say thank you for your time today, and thank you for your continued confidence and trust in us. Have a great day.